Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com, and I want to take a look at the Canada versus yen. It's one of the big movers today. It's up around 0.92% on the day, erasing some of the declines from Friday. But I also want to talk about some of the tools that I use to define risks, to define trading opportunities, and as a way for you to become familiar and also look for these opportunities yourselves when you trade. Now, I'm looking at the hourly chart of the Canada versus yen, and what you can notice off of this chart is that there is I've drawn some trend lines. First of all, the trend lines, there's a trend line right here, and note how many points that trend line finds support against. A number of different points along those lines, right? So that increases the level's importance. And also I drew and outlined some of these yellow areas. I call these yellow areas swing areas. In my book, Attacking Currency Trends, I define them as remembered lines or remembered areas as well. So one or the other. But what you look for in a remembered or swing area are commonalities where the market traders, remember, traders define these levels, and where where the traders found support or resistance and started to use that area or that level or those levels as a level to lean against. So for instance, we had a high right here, just a random high off of this chart. We come over here, we break above that level by a few pips, and the market fails up there, starts to come down. So we can draw a line, against the high right here, and then the market comes up to that area, finds a support and moves higher through here, corrects down to this low area right through here, and as a way of supporting what was once resistance is now support. And so the price moved up to a high price, and when the market came back down through the area right here, we started to see more selling on the break, and then we came back up and we retested that swing area. Note what else we retested. We retested the broken trend line right here. So not only did the price here break below the swing area, but we also broke below the rising trend line, came back up to retest the swing area and the broken trend line and the 100-hour moving average, which is a blue line in this chart. So all those things kind of converge together up here, giving traders a decision. Okay, what is the decision? To either go higher, retest the extreme from last week, or move lower, and that's what happened on Friday. The market moved lower, came down to another swing area, swing high, swing low, swing high, little fuzzy through here, break to the upside, come back down to the swing area, find support against that level on the way up, and then break below that. We also fell below the 200-hour moving average right at this point as well. And so again, buyers turn to sellers, selling momentum continue to move all the way to the downside. Now let's go to this trend line that I drew here, and this trend line connects a low from here to low from here, and as you can see, the low price today got close to that area before bouncing to the upside. Once the price started its move to the upside, where do we go? We went back to the swing area, went back to the 200-hour moving average, and so far we're seeing sellers against that area and against the 200-hour moving average. So what is that? How does that help you as a trader? Well, traders want to find levels where they can define risk, limit risk, and accept risk. So if you were to buy against this trend line down here, what is your risk if the price goes below that line? So I'm going to just circle right here. This would be the risk of that trade. If we start to see more momentum to the downside, you start to think about getting out. Some other traders might use a 50% retracement as a risk level, in which case you're risking this amount on the trade. It's still relatively small compared to what we ended up getting. Now this is hindsight, of course, but from a risk standpoint, if you risk 1% of your account balance on this trade right here, you could afford to have this market move to the upside right there. And that is how traders make money, is they find these levels where there is either commonality or good support or good resistance, where a lot of traders can easily draw a trend line and see where that level comes in, or they can put a Fibonacci of a move and see where there's a target on the downside on a break, or another risk defining level that may correspond with another swing area or swing low, which is propelled the market to the upside. Alternately, on the top side, traders can look for the underside of the broken trend line, the 100-bar moving average, the swing level, define their risk against this level. If the price were to go above it, start to trade more in that upward direction, you have a bias to sell. It doesn't go your way, you get out when the price moves above there and you take your loss. Alternatively, you can risk that amount and have the price move hopefully in your direction, get below the 200, get below the swing area, and you're on your way to a profitable trade. So with the price currently at the 200-hour moving average, what is an option for traders? Well, they can sell against that level with a stop above the 100-hour moving average, or they can sell against that level with the stop up here against the swing level. It's your choice, but that's how I would look at it from a trading perspective. That's an opportunity. If you were a buyer down here, what do you want to see? You can either take profit right here and hope that the price, that you book the whole move to the upside here, again with risk, maybe that amount, or you could hope that the price moves higher, in which case you want to see the same levels broken on the top. You want to see the 100-hour moving average broken. You want to see this level broken. You want to see all this taken back and the price move back higher. So that's your choice as a trader. That's how traders make money. They look for these opportunities in their charts and try to define the risk, limit the risk against the levels, and hope for the best. There you have it, a look at the Canada versus yen, just a random currency pair, but it follows the technical tools that I and other traders tend to look at and use to define risk, limit risk, and accept risk. Good fortune with your trading. Bye-bye now.